Welcome to Educational Series presented by Creative Financial Orientation, your financial compass. In a world driven by rapid change and fierce competition, numbers alone are no longer enough. We invite you on a journey into the world of management accounting, a field that doesn't just record outcomes, but shapes decisions, drives strategy, and unlocks sustainable success. In this series, we'll explore how data becomes insight, how numbers guide planning and performance, and how smart financial thinking empowers growth. Whether you're a business leader, entrepreneur, or aspiring professional, this series is designed with you in mind. Let us start. Management accounting, a pillar for strategic decision-making and operational performance. Management accounting is a vital information system for modern organizations. Its role goes beyond recording financial transactions to delivering deep insights that support management at all levels. This report explores the essence of management accounting, highlighting the key differences between it and financial accounting, while also discussing its objectives, concepts, tools, practical applications, and its pivotal role in the business environment. Management accounting is more than just numbers. It is a specialized information system designed to collect, store, and analyze both financial and non-financial data. But its real value lies in what it delivers: insights that empower senior management to make strategic plans, control operations, and take informed decisions. Let's turn to the definitions offered by leading institutions. The Institute of Management Accountants (IMA) describes management accounting as a profession that goes far beyond bookkeeping. It involves partnering in decision-making, designing planning and performance systems, and offering expertise in financial reporting and control. In other words, today's management accountant is a strategic partner, actively shaping the future of the organization. Similarly, the Chartered Institute of Management Accountants (CIMA) defines it as a systematic process, identifying, measuring, analyzing, interpreting, and communicating data used by management for internal planning, evaluation, and control. It even extends to external stakeholders like regulators, shareholders, and tax authorities. Now consider this: the IMA itself evolved from the National Association of Cost Accountants to the Institute of Management Accountants. A clear shift from mere cost tracking to enabling strategy and performance. What truly sets management accounting apart, though, is its embrace of non-financial data. Things like customer satisfaction, employee engagement, and operational efficiency. These are the metrics that give leaders a complete picture, not just financial results, but the drivers behind them. Because at its core, management accounting is about clarity, about foresight, and about giving decision makers the tools to lead with confidence. In this part of our training series, we're going to explore one of the most fundamental distinctions in the field of accounting. Here, we will highlight the key differences between management accounting and financial accounting. While both are essential pillars of financial information, they serve very different purposes, and understanding these differences is critical for anyone involved in business decision-making. Let's break it down step by step. 1. Target audience. Management accounting is designed for internal users, the people running the business: managers, executives, department heads. In contrast, financial accounting is aimed at external users, investors, creditors, regulators, and government authorities. These are people who are outside the company but need to understand its financial health. 2. Time focus. Management accounting looks both forward and backward. It uses historical data to understand trends, but its main goal is to support planning and forecasting for the future. Financial accounting, on the other hand, is backward-looking. It strictly reports on past performance, what already happened in the last month, quarter, or year. 3. Standards compliance. Management accounting is highly flexible. It doesn't follow international standards like IFRS or GAAP. This allows it to adapt reports to fit the specific needs of the business. Financial accounting must strictly comply with these standards, ensuring consistency, comparability, and legal compliance. 4. Type of data. Here's a key distinction. Management accounting uses both financial and non-financial data. This includes things like customer satisfaction, employee performance, or production efficiency, because those factors also impact business decisions. Financial accounting sticks only to quantifiable financial data, like revenues, expenses, assets, and liabilities. 5. Type of reports. Reports in management accounting are internal, informal, and as detailed as needed. A report could be daily, weekly, or even custom-built for a specific decision. Financial accounting reports are formal, structured, and periodic, typically quarterly or annually, and they're shared with external stakeholders. 6. Main objective. The main purpose of management accounting is to support decision-making, enhance operational efficiency, and provide planning and control tools. Financial accounting's purpose is to present an accurate financial picture of the company as a whole, its position, performance, and compliance. 7. Audit requirements. Management accounting reports are for internal use only, so they're not audited externally. Financial reports, however, must be audited by external, independent auditors to ensure their accuracy and reliability. 8. Area of focus. Management accounting focuses on specific units or departments within the business. It asks questions like, is this branch profitable? Or, how is this team performing? Financial accounting, in contrast, zooms out. It looks at the entire organization from the top level. 9. Techniques used. In management accounting, we use a mix of tools, statistics, forecasting models, performance metrics, whatever helps us analyze and interpret data. Financial accounting relies primarily on double-entry bookkeeping, the traditional method of recording financial transactions. So, while they may seem very different, management accounting and financial accounting are complementary. You can think of financial accounting as the foundation. It gives us the hard numbers. And management accounting builds on that foundation, turning those numbers into insights, plans, and actions. However, and this is important, if financial accounting is weak, inaccurate, or delayed, it can seriously undermine the quality of decisions made through management accounting. That's why both must work hand in hand. Management accounting's flexibility and adaptability make it especially valuable in today's fast-changing business world. It gives leaders the ability to respond quickly and smartly, unlike the slower, standardized nature of financial accounting, which is designed more for external reporting than for real-time decision-making. That's it for this section. In the next module, we'll dive deeper into the objectives of management accounting and how it supports daily and strategic business decisions. Stay with us. In this section, we'll explore one of the most important topics in management accounting, its core objectives. Management accounting is not just about producing reports, it's about enabling better management. Let's go through the primary objectives one by one. 1. Support decision-making. At its core, management accounting exists to support decision-makers. It provides both financial and non-financial data, helping managers choose between alternatives. For example, should we launch a new product? Outsource production? Expand into a new market? The right data leads to the right decision. 2. Assist in planning and policy formulation. Management accounting helps in setting goals and action plans. It delivers detailed reports that help managers plan for the future, allocate resources wisely, and set effective policies. Think of it as the GPS of business planning. It shows you where to go and how best to get there. 3. Control and performance evaluation. Once a plan is in place, the next question is, are we staying on track? Management accounting monitors actual performance against planned targets. If there are deviations, for example, higher costs or delays, it highlights them early. That allows the organization to take corrective action in real time. 4. Interpret financial information. Let's face it, not every manager is a financial expert. Management accounting translates complex financial data into simple, practical insights. It tells a story that non-accountants can understand and act on. This interpretation bridges the gap between raw numbers and effective decisions. 5. Employee motivation. This may surprise you, but management accounting also supports employee motivation. By setting departmental goals, tracking performance, and providing regular feedback, it fosters accountability and encourages continuous improvement. It's not just about numbers, it's about people, performance, and progress. 6. Communicate facts and evaluate policy effectiveness. Management accounting ensures that key facts reach the right people at the right time. It acts as a communication bridge between departments and senior management. It also helps evaluate whether internal policies are working, and if not, where adjustments are needed. Taken together, these objectives form a powerful framework for accountability, operational excellence, strategic alignment, and a culture focused on results. In short, management accounting enables smarter management. In the next part of this course, we'll look at the core concepts and principles that guide all management accounting practices, from cost analysis to performance measurement. Now that we've covered the objectives of management accounting, it's time to dive into the core concepts, the building blocks that make management accounting work. Let's break them down. 1. Cost analysis and behavior. Every decision in business comes with a cost. Management accounting begins by understanding these costs, especially how they behave. We analyze fixed costs, costs that stay the same regardless of production volume, like rent or salaries. Variable costs, which rise and fall with production, such as raw materials. And overhead costs, indirect expenses like utilities or equipment depreciation. By knowing how costs behave, businesses can price more accurately, control spending, and maximize efficiency. 2. Cost-benefit analysis (CBA). This is one of the most powerful tools in a manager's toolkit. CBA compares the expected benefits of a decision, like increasing revenue or saving time, against the associated costs. If the benefits outweigh the costs, the decision may be worth pursuing. Sounds simple, right? But here's the challenge. Not all benefits are easy to measure. Things like brand reputation or customer loyalty may not have a direct price tag, but they're incredibly valuable. That's where professional judgment comes in. Good management accounting helps us estimate, interpret, and weigh these intangible elements, not just the numbers. 3. Balanced scorecard (BSC). Traditionally, companies focused only on financial results, but that's no longer enough. The Balanced Scorecard, developed by Kaplan and Norton, introduces a broader perspective by looking at 4 dimensions of performance. Financial perspective, are we profitable? Customer perspective, are we satisfying our customers? Internal processes, are our operations efficient? Learning and growth, are we improving and innovating? This integrated approach helps leaders see the full picture and align day-to-day operations with long-term goals. 4. Principles of management accounting. Finally, management accounting rests on a set of guiding principles. Think of them as the compass that keeps us on course. Objectivity, base decisions on facts, not opinions. Prudence, be cautious and thorough in your assessments. Causality, link every cost to the activity that caused it. Integration, ensure all systems and data work together. Comparability, use consistent methods to allow benchmarking. Decision focus, always align information with decision-making needs. These principles ensure that the information produced is not only accurate, but also relevant, practical, and trustworthy. To sum it up, management accounting isn't just about tools. It's about thinking clearly, analyzing deeply, and making sound business decisions using a structured framework. In our next module, we'll explore how these concepts translate into real roles inside organizations, from strategy to daily operations. Now that we've explored the core concepts of management accounting, let's talk about its real impact inside organizations. So, what does management accounting actually do for a business? In simple terms, it empowers management with the right tools, data, and insights to lead strategically and operate effectively. Let's walk through the key roles it plays. 1. Strategic planning. Management accounting supports long-term decision-making. Should we enter a new market? Launch a new product? Restructure our operations? By providing detailed forecasts and financial models, management accounting helps leaders evaluate opportunities, understand the risks, and plan ahead with confidence. It doesn't just answer, "What happened?" It helps ask and answer, "What should we do next?" 2. Resource allocation. Resources in any organization are limited, whether it's money, time, or talent. Management accounting identifies where to save costs, where to invest, and how to deploy resources most efficiently. For example, should more budget go to marketing or product development? Should we outsource or build in-house? It's about putting the right resources in the right places to generate the best returns. 3. Compliance and control. Every organization has internal policies and external regulations it must follow. Management accounting plays a key role in ensuring compliance, not just legally, but also operationally. It tracks whether departments are sticking to budgets, whether procedures are followed, and whether performance aligns with the goals set in advance. It acts as a system of checks and balances to keep things on course. 4. Performance measurement and risk management. Management accounting helps businesses monitor performance through clear and measurable KPIs, key performance indicators. But it also goes beyond reporting. By identifying early warning signs like rising costs, delays, or low productivity, it enables proactive risk management. This allows leaders to respond before problems become crises. In summary, management accounting is not just a reporting function, it's a strategic partner. It reduces uncertainty. It promotes a data-driven culture where decisions are based on facts, not assumptions. And it strengthens the organization's ability to adapt, grow, and succeed in a fast-changing world. In the next module, we'll explore the actual tools and techniques used in management accounting, from budgeting and cost analysis to break-even and capital investment decisions. By now, you understand what management accounting is. You know its goals, and you've seen its role in driving performance and strategy. But here's the big question. How does it actually work in practice? What are the tools that make management accounting come to life? In this module, we're going to explore the key tools and techniques that management accountants use every day to turn raw data into smart decisions. Let's dive in. 1. Budgeting. We start with one of the most fundamental tools, budgeting. It's all about planning and controlling future income and expenses. Budgets help organizations set goals, allocate resources, and track performance. Whether it's a sales budget, a cash budget, or a capital budget, budgeting keeps your business on course. Think of it as your financial roadmap. 2. Cost accounting. Want to know how much your product or service really costs? That's where cost accounting comes in. It breaks down every expense, direct and indirect, so you can price accurately, cut waste, and improve margins. From manufacturing firms to tech startups, cost accounting is your profit detective. 3. CVP analysis, cost volume profit analysis. This tool looks at the relationship between costs, sales volume, and profits. It helps you answer questions like, how many units do we need to sell to hit our target profit? What happens to our profit if we lower the price? Where's the break-even point? CVP analysis shows the tipping points that matter. 4. Break-even analysis. Speaking of tipping points, break-even analysis tells you the exact sales level where your revenues equal your total costs. No profit, no loss, just the line in the sand. Go beyond it, and you're profitable. Fall short, and you're in the red. Simple, powerful, essential. 5. Variance analysis. Plans are great, but reality often has other ideas. That's where variance analysis comes in. It compares what you planned to what actually happened, and then digs into the why behind the difference. Are we over budget? Is production underperforming? Variance analysis is your early warning system for performance issues. 6. Capital budgeting. Now let's talk investments. Should we build that new warehouse? Launch that new product line? Capital budgeting uses tools like net present value (NPV) and internal rate of return (IRR) to evaluate whether long-term projects are worth it. It's not about guessing, it's about calculated risk. 7. Pricing strategies. Setting prices is an art and a science. Management accounting helps you determine optimal prices by analyzing cost structures, market conditions, and customer value. Whether it's cost-plus pricing, market-based pricing, or value-based pricing, this tool keeps your margins safe and your customers happy. 8. Cash flow analysis. Profit is great, but cash is king. Cash flow analysis monitors the ins and outs of your liquidity. It tells you if you can pay your bills, fund new projects, or survive a slow season. Solid decisions require healthy cash. 9. Constraint analysis. Every business has bottlenecks. It might be a machine, a department, or even a policy. Constraint analysis helps identify these limitations, assess their impact, and find ways to maximize throughput. It's all about getting more done with the resources you already have. Working in harmony, these tools don't work in isolation. They're part of an integrated system, a dynamic feedback loop that helps managers plan, act, monitor, and adapt in real time. You budget, you act, you measure, you adjust. This cycle of learning and improvement is what gives organizations their strategic edge. And what about technology? Good question. Today, we're seeing traditional tools being supercharged by artificial intelligence, big data, automation. These innovations improve speed, accuracy, and depth of analysis. AI can generate forecasts in minutes. Big data can reveal customer trends no human could spot. Automation reduces time spent on repetitive reporting. The future of management accounting is smart, fast, and insight-driven. Wrap up. So, the next time someone asks, how do companies make smart financial decisions? You'll know the answer with the right tools and the right mindset. And that's what management accounting is all about. By now, you've seen the tools, the techniques, and the strategic power of management accounting. But how does all of this actually play out in real business environments? Let's explore how management accounting supports performance, strengthens operations, and becomes a true engine for competitive advantage. 1. Enhancing efficiency. Let's start with one of the most practical outcomes: efficiency. Through cost analysis, process monitoring, and performance tracking, management accounting helps businesses spot waste, whether it's excess inventory, redundant processes, or low-yield operations. Once the inefficiencies are identified, management can act fast to streamline, automate, or reallocate resources. Less waste, more value. 2. Supporting strategic and tactical decisions. From daily pricing decisions to long-term investment planning, management accounting supports both the tactical and the strategic. Imagine you're launching a new product. You'll need to forecast demand, estimate costs, assess break-even points, evaluate pricing strategies. All of that flows from management accounting. It provides the decision-making backbone your business needs, day to day and year to year. 3. Monitoring and correcting performance. Plans are only as good as their execution. Management accounting ensures that performance stays on track by constantly comparing actual results to planned objectives. And when there's a deviation, it doesn't just point fingers. It provides the data to understand why and the tools to correct course. It's like having a built-in GPS for your business performance. 4. Resource planning and inventory management. Management accounting plays a vital role in managing supply chains and inventory. With tools like inventory turnover analysis, reorder point tracking, and cash flow forecasting, you can avoid overstocking, prevent stockouts, reduce holding costs, improve delivery timelines. That means smoother operations and happier customers every time. And what about competitive advantage? Here's where management accounting really shines. It helps organizations build and maintain a competitive edge by enabling cost leadership, produce more for less. Profitability optimization, focus on high-margin products and services. Rapid market response, react quickly to changes in demand, cost, or competition. Innovation support, evaluate and fund new ideas with confidence. It's not just about tracking the past, it's about shaping the future. Beyond the numbers, sustainability and responsibility. And here's something that sets great businesses apart today: social and environmental responsibility. Modern management accounting isn't limited to dollars and cents. It can also track carbon footprints, ethical sourcing, social impact, and more. By integrating these non-financial indicators, companies make decisions that support not just profits, but planet and people too. That's how management accounting becomes a tool for sustainability and long-term stakeholder trust. Final thought. So, in dynamic, competitive, and socially conscious business environments, management accounting isn't optional. It's essential. It empowers organizations to perform better, think smarter, and grow sustainably. In our next and final module, we'll bring everything together with real-world examples of how management accounting creates measurable impact inside successful businesses. This is Creative Financial Orientation, your financial compass. Stay with us, we're almost at the finish line. This will be our final module, and this one is where theory meets action. We've talked about the tools, the principles, the strategy, but now, let's see it in action. How does management accounting work in the real world? Let's dive into some practical, relatable examples that bring it all to life. 1. Production cost analysis. The furniture company. Imagine a furniture company that wants to increase its profit margin. By using management accounting, they calculate the true cost per unit, including wood, labor, electricity, and overhead. This allows them to adjust pricing accurately, eliminate material waste, and boost profitability. That's cost awareness in motion. 2. Inventory management. The e-commerce firm. Now, picture an e-commerce business with thousands of products. They use an ERP system powered by management accounting to track real-time inventory levels. This means no more overstocking, no more stockouts, faster shipping, and happier customers. Inventory becomes a competitive strength, not a guessing game. 3. Performance monitoring. The restaurant chain. A restaurant group with branches across the city uses management accounting to monitor KPIs by location. They track revenue per table, food cost ratios, staff productivity when one branch underperforms. They know exactly where, why, and how to respond. It's performance management served hot. 4. Project management. The construction company. Building on time and within budget is everything in construction. By monitoring actual versus planned costs during each project phase, a construction company avoids cost overruns, missed deadlines, and unhappy clients. Management accounting gives them control from blueprint to completion. 5. Variable cost management. The SaaS startup. Software companies often work with subscription-based revenue. One SaaS startup used management accounting to link support costs, server usage, and subscriber growth. When growth spiked, so did variable costs. And with smart analysis, they restructured pricing, improved scalability, and protected their margins. That's how you scale without losing profit. 6. Customer and supplier analysis. The distribution company. Not all customers are equally profitable. A distribution firm used management accounting to analyze which clients bring the most value and which suppliers deliver the best efficiency. The result? They focused on high-margin accounts, negotiated better deals, and improved overall profitability. It's strategic relationship management guided by data. 7. Debt and capital management. The startup. A young startup wants to grow. But how? Management accounting helps them evaluate debt options, interest costs, return on investment. This helps them choose the right type of funding without overwhelming their cash flow. Smart growth starts with smart capital planning. 8. Forecasting and planning the retail brand. Finally, a retail company uses sales forecasts to plan for the busy season. By analyzing historical trends, market shifts, and promotional strategies, they align purchasing, staffing, and inventory with expected demand. Less waste, more sales. That's forecasting done right. Final thoughts. As you can see, management accounting isn't just theory. It's the quiet engine behind pricing decisions, budget control, operational agility, and strategic growth from factories to restaurants, from tech startups to retail giants. Management accounting drives smarter business every day. And here we are, the final step in our journey. Throughout this series, we've explored the powerful world of management accounting, not just as a concept, but as a living, breathing force within every successful organization. Let's bring it all together. While financial accounting ensures transparency for the outside world, management accounting looks inward. It empowers leaders, sharpens strategy, and turns data into decisions that move businesses forward. It's not just about the past. It's about the next move, the next opportunity, the next breakthrough. With its unmatched flexibility, its focus on the future, and its ability to integrate both financial and non-financial information, management accounting helps organizations achieve their goals, build sustainable performance, and gain a true competitive edge. It's a toolkit for growth, a roadmap for agility, a compass for innovation. And as the business world transforms with AI, automation, big data, and shifting global dynamics, management accounting isn't standing still. It's evolving, leading, becoming even more essential. It's not just part of the business. It's the heartbeat of informed decision-making. So, as we close this course, remember, wherever you go in business, whether you're managing a small startup or scaling a global enterprise, management accounting is your silent partner, always there, always guiding, always ready to help you take the smartest next step. From all of us at Creative Financial Orientation, we thank you for being part of this journey. We hope this series has not only taught you how to manage numbers, but also how to lead with clarity. Because when your direction is clear and your data is trusted, there's no limit to where you can go. Stay curious. Stay